know, I'm your host, Dan Theox, Senior Vice President of Investment Banking here at Mayberry Investments Limited. Joining me today are our panelists, Executive Chairman, Mr. Christopher Berry, and alongside me is our CEO, Mr. Gary Peart. Today we'll be presenting you Mayberry Investments audited financial statements, so be sure to stick around till the end of the program where we'll allow folks from social media to ask us questions. Before we get started, I'd like to remind you guys, if you're looking to expand your investment portfolio or embark on your very first investment journey, Mayberry should certainly like to help you in making your first choice. So follow us on social media and give us a call to learn more about how we can help you secure your financial independence. Okay, so now I'd like to welcome Gary and welcome Chairman Berry.
Welcome, Dan.
Good deal. Well, I'd like to present the audited financial statements for Mayberry Investments Limited, and after that, we'll be taking some questions via social media live, or you guys can feel free to send in questions from beforehand. So first up, what do we have for you? The actual audited financial statements for Mayberry Investments Limited for the year ended December 31st, 2021. So first slide. What we have here is sort of a 5-year highlight of how the business has performed for the last 5 years. And what I want to highlight is the 5 times growth in net income over this period from $1.2 billion up to $4.4 billion, and the growth, the substantial growth in profitability from $478 million in 2017 now up to $3.06 billion. Also, that period, we've managed to grow the shareholders' equity by 112% from $7 billion to $15 billion. And yet, we've only seen the stock price move by about 48%, Gary, from $5.38 to $8. Next slide. This shows again the growth in the net operating revenues, again from approximately $1 billion in 2015 to 4 times that now to $4.5 billion in 2021. Notably, last year we had a net loss of $1.8 billion, and that was after about $3 billion in fair value adjustments for our portfolio that went through the P&L. Which this year has reversed, and we've seen over $4 billion in fair value adjustments in the P&L, and I'll be talking a little bit about that because we've got the associates as well as just our general financial assets, and we'll definitely be talking about the great jump in fair value for our associates. Next slide. This shows how we've managed to contain operating expenses over the last 5 years, particularly in 2021. And on the next slide, we're showing the total growth in the balance sheet in particular, total assets growing by over 15% in the last year alone, up to a whopping $41 billion, and shareholders' equity growing by 16% in the last year alone, up to $15.3 billion. So this is substantial growth in shareholders' equity, with over $10 billion of that being retained earnings. And so Mayberry has great capacity to pay dividends, great capacity generally, and it's pretty impressive. Our net book value per share now up to $12.7, again, compared to a stock price of $8, and we'll talk a little bit about that again. Well, why is this stock trading at a discount to its book value, and why is it trading at such a low PE ratio? We'll be talking a little bit about that, and I'm sure that'll turn up as 1 or 2 questions for Chris or Gary as we go forward. On the next slide, this sort of again depicts in a graphical format the growth in assets over the last 5 years in particular, again from $24 billion up to $41 billion, whilst the growth in liabilities has been far lower. So the overall growth in the net book value and the shareholders' equity is sort of pronounced in that way. Next slide. I want to get into discussing what I implied before, which is the great dividend-paying capability of Mayberry over the years. And this is a stock that came out, IPO'd in 2005, and they raised approximately $1.1 billion from the market, if my memory serves me well. And since that period, they've paid back $3.4 billion in dividends, so 3x times what they raised. So whilst the share price hasn't been jumping as much as I would like to see, if you join this party from day one, you've already gotten back 3.5 times, 3.4 times to be exact, your initial investment in the form of dividends with a whopping 32 cents dividend last year to the tune of over $400 million. So very impressive in terms of the dividend paying power of the MIL stock. So it's definitely something, folks, you want to get into your portfolio. On the next slide, again, looking a little bit more at some of the financial metrics. Next slide. We show again, sort of in a graphical format, the cumulative net book value plus the dividends you've received over the last 8 years, from 2013 to 2021, and you can see that again, if you would bought this stock at $3.35, $5, 2035, you would have gotten back $15 effectively in your hands. So that's very impressive, and that's the green line. Whilst the blue line just shows sort of the growth in the net book value per share of the business, again growing from $3 per share to $12.77 per share. And I mean, that's impressive, irrespective of inflation, which has probably averaged about 7% per annum over that same period. So great value in terms of the balance sheet and actual performance of the company. So again, I have to keep asking myself, why is the stock price not following suit? Next slide. This sort of shows again, the other financial stocks in the market, the share prices, PEs, book values, price to books, and things like that. And what I want to say is sort of the average PE we've been seeing in the markets about 14 times, and yet Mayberry is trading at $5.83, so obviously significantly undervalued despite growing profitability substantially over the last 5 years and the last year in particular. So again, that signals to me a great opportunity to buy the stock if the P is as little as 583, when the market average is 14 times. That signals a great time to buy. Also, the price to book. Again, this stock is trading at a discount to its book value. So again, we speak to the $15 billion in shareholders' equity, and you translate that into a price per book, which we said was roughly $12.77, yet the stock's at $8. And so that demonstrates that the stock is trading at a 22% discount to book, when again, most peers in the financial sector, I think the average price to book is going to be closer to 1.7 times. So again, it's substantially below book, substantially below PE, and again, that signals a great opportunity to invest in the company. Closing stock price as of yesterday looks like it was $10.02 compared to year end, which we're highlighting, where it was $8. So again, we've seen a little bit of growth in the last 4 or 5 months, maybe 15%, but again, still substantially undervalued from both a PE perspective and a price to book perspective. Next slide. And this sort of shows the MIL estimated value versus the share price. And again, it sort of demonstrates the value that we see in the stock. Again, that blue line showing the share price versus the main market PE, the black line where we think it should be. And so, I think when you look at this carefully and make your analysis, the stock is, between $8 and $10 right now. It should really be closer to, $16 to $18 based on the actual performance from our perspective, and the business continues to grow. And when we talk about that, you'll definitely appreciate that the performance in 2021 wasn't simply a reversing of 2020, but it demonstrates the growth potential and continuous growth potential that we believe Mayberry still has. Next slide. Okay, and that's it. So first comment I want to make, Gary, before I ask you what's the obvious question to me. First comment I want to make is we've seen where Mayberry has 4 key associates that it's invested in, and that's driving most of the value that we've seen in the last year.
John?
Hey, Chris?
Yeah, the viewers are saying that the audio is low.
Okay, folks, let's try to adjust the audio a bit. We're hearing, I'm certainly hearing myself
very well.
and hearing you pretty good, but we'll make some adjustments for that, folks. We apologize. So first observation I want to make is Mayberry's got 4 associates that is driving significant value for the business, and those four are SVL, CPJ, Last F, and Iron Rock. And I'm going to bet SVL and CPJ sort of give the lion's share of that performance. We talked a lot about SVL already, and I think it's a great company, and Gary is the executive chairman there. And I do not have to declare interest because I've just said they're associates, so you guys know what that means. It means we have a substantial stake and influence over these four companies. The second one is CPJ, and we've seen CPJ share price go from $4 to $18, and we're going to definitely have Mark Hart on the program in the upcoming weeks. We've seen their financial results just come out, Gary, for the last quarter. This business has clearly, transformed themselves. They've gone from a best year of profit of about $4.5 million US to making $5.5 million in the first half of the year. It just made 1.8 in the quarter, so that's 7.3. They're clearly going to make 9.5, $10 million for the full year. And so, I mean, as they do well, obviously we're going to do well. We're sort of bench and batty, very closely tied to them. Gary, any general comments you want to make about our investment in CPJ and how you're feeling about that stock right now, which is, again, one of our associates that's driving great value from Mayberry?
So, thank you for that, Dan. Welcome all, Chairman. Good to see you. So, the first thing I'm going to do is to dispel an interesting myth. So, the questions that you asked about the associate, they're an associate company of Mayberry Jamaican Equities. So, Mayberry Jamaican Equities is a subsidiary of Mayberry as at the end of 2021.
Correct.
Right? And so there are a lot of people who feel that MJE basically represents the majority of Mayberry. So I get the opportunity today to enlighten a lot of people. So yes, whilst the performance of MJE is important to Mayberry, and let's put it into perspective, what was the profit again for MJE?
$3 billion.
It was a little bit below that. We have
MJE, sorry,
for MJE.
Yes.
So I think MJE did about $2 billion.
Correct.
And when you consolidate Mayberry, Mayberry has done about $3 billion.
Yes.
For 2021. So what that is saying is that whilst MJE produces a big piece of our profits, it's not everything.
Correct.
And you're seeing that there are other things that Mayberry is doing that's generating significant value. So that's what I'm going to try and explain here. So we started MJE with an investment of approximately 10 million US in 2006, give or take, and that's in excess of $100 million, and that continues to do well. And we've had things about MJE. So Mayberry itself, Mayberry now is where, as we would say, the real gungo, right?
Yeah.
So this is where we arrange deals, corporate finance, investment banking that you do so well at, Dan. And we also have another subsidiary of Mayberry, which is where we put all our private equity transactions.
White-based.
And which is called White-Base Limited. And what basically has happened, and people would have realized that our audit is a bit late. The reason for that is that we had changed auditors. So between changing the auditors, COVID, the impact of COVID on the staff, etc., it created this perfect storm, and it is delayed. But what has happened is that we have adopted a new accounting philosophy, and it has resulted in a lot of restatements of some assets. And in general, those restatements have actually increased in a positive way.
Right.
So, for example, we're investing in a real estate project. I would argue that it's the last largest undeveloped piece of land in Jamaica, about 30 acres. That's Cherry Hill Developments. And we've built one building, we're about to build 2 more buildings. And so for 2021, we had to take to book the profit that we made on the first building. And then also, as we developed that property, the restatement of that property, generated additional gains from there. There are other very exciting private equity deals that we've done. That's, as I said, private. It's not out there in the public space. So as they come to fruition, you will see those being booked. So, you could wake up one day and you just hear that, hey, here's a $10 million profit US that is just coming through. Because those are a lot of the stuff that we do, but it's not yet mature. And once we get it to a point where it's matured, we'll probably list them, carry them further, etc. Our Cambio business, foreign exchange business, did extremely well for 2021, and that shows in the numbers again. Also, our trading business, because again, we're a big purveyor of trading of government securities, etc., on behalf of ourselves and also for our clients. And the exciting and biggest potential area in the business now is our pension management and money management, or asset management type business that's run by Damian Wiley. And that's an area that has significant prospect for growth because, for example, our IRP, the individual retirement plan, the return on that pension plan is one of the highest of all the pension managers out there. So, Mayberry as a pension fund manager is one of the biggest secrets that's out there because we have a boutique set of clients that we do this for. So in addition to investing in MJE, where you get the best ideas of Chris, Mark, and Gary, you can actually give us your pension fund, and you can then inherit some of that excellent investment management business. As I said, for those pension funds that we have, the returns have been very good, and we continue to grow that side of the business. So those are the main drivers. And what continues to be a big driver for Mayberry is actually our interest income business. And a lot of people don't realize we have a very, very large book of clients that invest on our balance sheet, and we do earn money from interest income. You earn more on the security, you pay less on the debt, and we go down the road. So 2021 has been a very good year. And I think the thing that pleases me the most about 2021 is that our best year ever at Mayberry was 2019. We did about $4.7 billion in comprehensive income. And whilst we weren't able to get back to that level, to that profit specifically for 2021, what you will see from the book value of Mayberry is that in 2019, it was $12.84. It is now $12.77 as at December 31st. 2021, right? So the reality is that we are now into our first quarter, and our first quarter is also due. But the conversation here today is really about the audited, and people. I was reading something today, and there's somebody spoke about Shelly. They were speaking about Shelly Ann and calling it Pocket Rocket, right?
Yeah.
And I see Mayberry in the same way. It's a company that people think should be small, but our results are just significantly greater. So Shelly is just 5 foot, but when she sprints out of that block, nobody's getting there, other than Elaine sometimes.
Yes.
Right? But that's how I kind of see Mayberry, in the sense that we're always surprising. It doesn't matter how well the company performs. People are just saying, what's happening? Is that real? Is that this?
Yeah.
And I think it manifests itself in the stock. And what you're seeing is that this is the cheapest stock in the market. This is a stock that has the most value in the market. It's traded at 5 times. The profits have been consistently been there.
Yeah.
This is not one-off. Which is what some people used to say. When I came in 2005, I did the first deal, they say, oh, it's one-off. And every year we have several one-offs, so that is the line of business. And, I have to thank the team, I have to thank the board of directors led by the chairman. It all came together as a collaborative effort. And 2021 was really, really good. But I think we might beat it in 2022.
So, Chairman Berry, I have to ask you, is it possible that Mayberry could really outperform itself, what it just did in 2021, come in 2022, and what are you expecting in terms of growth? Where do you see good opportunities? Share some insights, Chairman, if you will.
I think the chairman has froze. All this excitement has frozen him.
So we'll get back
Unmute issues. Sorry
you're
about that,
talking
guys.
about storm and new
There you go.
Go ahead, Chris.
Yes, so 2022 I think it's going to be a better year for us than 2021, um, based on what I'm seeing so far. I mean, since December, we have had very strong movements in some of our main holdings, especially SVL, that moved from $19 to $30. Um,
Since March.
yeah, since March. And our regular mainline business is coming back now that COVID is over. You know, the traders and the fund managers and the financial advisors are picking up steam. So, you know, I will be surprised if 2022 doesn't beat 2021. Very surprised.
Thanks for that, Chairman. I appreciate that. So, Gary, as an example, we mentioned the partnership with Mustangs that's called Cherry Hill, and that turns up in our profit share in joint venture, where we saw we did $1 billion in 2020 and $300 million in 2021, and yet you imply that you have over 30 acres of land, perhaps the largest tract of land in Kingston developing. I think that first sale was just 3 acres of the 30 acres being developed. So
Right.
are you suggesting we could expect more future profits in this joint venture coming out of Cherry Hill?
Yes. So, we've done the first building on 3 acres. We have deals to do two more buildings, and interestingly, we did the first building on 3 acres, and we're now likely to. Now that we've learned better, we're now likely to do two buildings on 3 acres. So we would like to do that more efficiently than the first. But we have quite a bit of land left to develop there, and we'll do it systematically. We're not in a rush. We have a deep balance sheet, and so does most of our partners. So, we have the ability to pick and choose where, when, and how we would want to develop it, and obviously we're going to maximize as much as we can. So that, and it's an investment that we're pretty proud of, because we had the land for a little while, and we waited, and I think we chose the right time, to do what we're doing with it, and you'll hear more. You'll hear more about that.
No doubt, and there's obviously great potential for commercial real estate in the country, in the BPO space, in the warehouse
Definitely.
space, etc. And you have to read through the fine print, guys, but you'll see that Mayberry has over $7 billion in commercial real estate that it's looking to develop or make use of in the future. So that's an impressive business line. We discussed Widebase, which is our private equity arm of Mayberry, that very often helps us do our private equity play on companies, which then eventually, as we work with them and they mature, they go public. And yes, Philip Burgess, Edufocal is one such example. So Philip picked up on that.
Right.
And I can tell you guys that we have at least 5 other private equity plays in the pipeline, which will ultimately go public. And I'm hoping that we'll have at least 3 more public listings in the next 12 months. Ultimately, we intend to defend our status as IPO king and keep the IPOs coming in the marketplace.
I don't know about that status. We just do what we do.
You don't know about the
Yeah.
IPO king status?
No,
No.
if somebody wants to put that moniker, that's their thing. We just run the business.
Yes.
And we are what you call slow and steady wins the race.
Yes, yes.
And we invest, we advise what is best for our clients all the time. So if the market is not ready, we're not going to do it just to say that we need to do a listing. Yeah?
Right, no, obviously.
But there are deals around the place. And for the record, Cherry Hill is still private.
Yes.
It's just that they raised some money publicly, but the company itself is still private. But usually most of the companies we have in Whitebay stay that way until they actually move, like how Edifocal
Right,
move
right.
to come out. So, in short, ladies and gentlemen, Mayberry has several diamonds in the rough in these subsidiaries. That's not readily apparent. And, once they come out and we polish them, they have the ability to show significant returns. So now, when you step back and you have a business that is consistently throwing off profits, throwing off earnings year after year, and you only have a multiple of 5 times, but you have not yet factored into the mix these hidden diamonds that are going to come and just surprise you,
Yes,
right?
yes.
We like surprises, right?
Absolutely.
That's just going to come and surprise you. I mean, there has to be a number you ascribe to that. You know, it's not for me to say to you that number should be 30 times or 20 times, because if you go back to the slide, I don't know if you can bring up the slide, you know, show the slide better than, it looks better than us,
Yes, yes,
right?
yes.
If you go back to the slide, which was the last slide, I
They
think
had
it
the
says,
5.88 PE?
yes,
Or
that one,
yeah.
correct. What you're seeing, right? And, you know, in life, you don't get certain opportunities every day. And when they come, you know, I describe Mayberry as conservatively aggressive. This is an example of what Mayberry gets aggressive about, but even though we're conservative. The stock is trading at $8. I think yesterday it traded up to $10, right? But the average for the sector and for the market is saying the range is between $18.47 to $18.68, right? So it's saying that's where it should be. There was a time where the stock was trading above its true price. And you see it in the early days of Mayberry where there's a point where the stock was traded at 9, but the implied valuation was $1.80. And even it was closer before that when it was 570 odd relative to 537. But what you're now seeing is a significant departure as showed by that X. And when you get to the end of it to the right of the screen, you know, where those two the numbers 1847, 1868 is the average, is the financial market average. So you put all the financial services company and you have the main market, you use those two multiply, you get those two different numbers. But the stock is trading at $8,
Yeah.
right? And so it's gaps like that in the research that you do that you know back up the truck and dump your cash there. That's how Mayberry would view it,
Right.
As to the other investors out there, that's your choice. But one of the things I can say to you, this is something that the longer it occurs, it allows people like us, Dan,
Yep.
to pump more and more of our resources in it. Because the longer it stays undervalued, is the more times you can go back to the well
And buy it.
and
yeah.
buy it before it gets to 18, 20, or $40. Because remember, that's assuming a PE of about a multiple of 10 times. You have financial services companies within, if you can go to the slide before, yeah? So, you know, everybody views companies differently, right? And I have my views, but, you know, you decide. SGJ is Scotia or Saji? I think that's Scotia.
SGJ Scotia.
Right. So Scotia's PE is 13 times.
Yeah.
NCB is 14 times. Victoria Mutual is 15, almost 16. JMMB, which you always speak about, Keith was here. Even after moving to $46, it's 7.5 times. That's another one just waiting to blow up.
Absolutely.
SIL, I think that's
Sterling.
right, is at 8.2. Burrito is 26 times, right? So when you look on the earnings of Burrito relative to NCB, Scotia, etc., you know, what's all that excitement? First Rock, 7.6, that seems to be an opportunity. Proven, 11 times, 12 times, but that's more like a fund, right?
Yeah.
The stock exchange has a multiple of
34
34 times.
Look at the price to book, you know,
Right?
9
And
times.
a price to book of 9 times,
Yeah.
right? You know, if they had shorting in the market, you know, maybe a particular stock would be ideal for that. I
Yes.
won't say anything else
Yes.
about that,
Yes.
right?
Yes.
And then you have the rest of them. And at the bottom, you have Mayberry at 5.8 times.
Yep. And 0.7.8 from
And
a price to book.
0.78 times book.
And I want to see if we can try to make this point here. I'm going to go out on a limb here. I mean, we didn't discuss this before. Chairman is saying, I feel that you guys saw the same kind of value in Supreme Ventures when you made that play 4 or 5 years ago. That the company was, from a book point of view, profitability point of view, there was a great opportunity to make that buy. You guys put billions of dollars into Supreme Ventures. I know it was sub $10 by the time I joined the party. I bought at $10. You guys probably bought at $5, $6. That's up to you to say. And 4 or 5 years later, with some active management and some transformation, we've gotten that share price up to $30. But more importantly, the profitability of the business, is up to $1 billion per quarter in 4 or 5 years. And I feel like Mayberry is the same kind of investment opportunity. Someone's going to come back 4 years from today and say, geez, I got that stock at $6, $7, $8, and now it's at $18. So guys, when we talk about creating value, there are a lot of analysts who are on the sidelines talking, and then you have guys like Gary and Chris who are investing, and that's what makes an MJE portfolio go from $10 billion to $18 billion in short order. Mr. Berry, I have to ask you, I've heard you say that the stock market is one of the greatest ways to create wealth, and I see you actively doing that through MJE and through wide base. Now, wide base is where you do your private equity plays, and I'd just like to pick your brain a little bit. What are you looking for, Mr. Berry, in these private equity plays, and how have you been able to just find so many of them and so many great investment opportunities?
Well, one of the things we look for is cash flow. Are the companies able to generate cash flow? The other thing we look at a lot is the management. Are the people that we think we could partner with? So partner means, can we trust them? Are they hardworking? Are they smart? Stuff that you ascribe to great leaders. But most of all, we look for things that are scalable. Because if it's not scalable, then we're really not interested. So even some small companies we'll invest in. So when we first went to invest in Edifocal, it was a very small company. But, being in the education space, and we know that the education system in Jamaica needs a major overhaul. The last study that did, it shows that people with an average of 10 years schooling, 40% of them are functionally illiterate. I mean, that's a damning indictment on our education system.
Yeah, it is.
So, something like Edifocal, where you have a young guy, lot of energy, very hardworking guy, and he is playing into that space, we feel is very scalable. One of the things you have to remember though, Dan, and one of the benefits of investing through Mayberry, through MJE, is that some of these bets actually do go bad.
Mm-hmm.
Right? So, if we invest $1 million US in something and it goes bad, it's not the end of the world, that's less than 1% of the funds we're managing. So it doesn't affect anything that much. But when an individual now puts a substantial chunk of their money in that private equity play, it just multiplies the risk many fold. So we like to take these bets. They're calculated bets, and some of them have blown up. We have seen where we have invested in projects $1 million and we end up getting back like nothing. So it's not every project that wins, but so far, I think we're mostly on the winning side. So cut a long story short, management, scalability, cash flow, especially cash flow, we don't like making investments in stuff that hasn't proven that it can generate a positive cash flow, which is why Gary says we're conservative, So some people know in the tech world, people invest in a lot of stuff that don't make money, and they they hope it turns out well. And I don't know, Jamaica is a tough market, we don't have a deep venture market and a deep spec investment market like the US. So I think we have to be a little bit more conservative because, if you lose too much in Jamaica, people just not gonna bet on you anymore. So you have to make sure you have some winners.
Understood. And again, Mr. Berry's been at this for 30 years, folks. Mayberry itself has been around for 35 years. doing this. So we couldn't possibly summarize
37 done.
37
37.
years. I beg your pardon, sir. I've only been here for 5, so
Yeah, and I
I've
was a founding member, by the way.
yeah, I have no doubt. I have no doubt. I have no doubt. And
But sorry, Don,
go
if I
ahead,
could.
Gary. Yeah, absolutely.
There's also, just to add to Chris's list, there's also what I'd refer to as international arbitrage. So a lot of the companies we invest in, one of the things we find is that a lot of the local experts have a different valuation methodology. And so that also creates an arbitrage where, there's certain the valuations that some of the local guys place in some of these companies, in some instances is much lower than what the developed markets
Right.
place on these businesses. And I think I gave an example, it might have been the MJE when we spoke, but I made the point that, when Clico came to buy Lascelles, which had Jerry and Nephew at the time, I think the stock was trading somewhere around $90 to $100, before the deal came. But the deal came at over $400,
Right.
In case of Red Stripe, when the offer from Heineken came from Red Stripe was trading on our own, I think about $7, right? We can go back and check the actual figures. But it traded significantly lower than that for almost a year, right? And the offer that came from Heineken came at $33, right? So one of the things we do and what we look at, when we make certain investments, are these investments attractive or could be attractive to these international guys? And a lot of the investments that we have now, we're consistently looking on international markets to see what the valuations, etc. So whilst locally, so when you speak about SVL as an example, when Mayberry and its crew, for want of a better word, made the investment, it don't feel too bad. I think it was $9.38. And people were buying, right? And in some instances, local people are not buying because they think, the PE is too high, right? So, but they don't understand the type of growth that will come from SVL that would significantly haul down that PE.
Right.
Plus the fact that it throws off a ridiculous amount of cash.
Yeah.
But the key point, which is the point I'm making here, if somebody takes the time and do an analysis of what lottery companies, the size of SVL, sell at in terms of the multiple, you will find that locally we're not valuing SVL anywhere near its true value, right? And so one of the things that we've proven is that your exit does not necessarily have to be to a strategic partner within Jamaica or the Caribbean. Your exit can be to an international investor. They have deeper pockets. And it's not just an SVL, it is almost every company that is listed on the stock exchange. The largest company in the stock exchange barely qualifies as a medium-sized company in the United States using their metrics, yeah? So they're all targets. They're just waiting for a particular point where it makes sense for whatever that individual or fund is, and they will make their play. So that's one of the secret sauces. So we try to find investments that we think will be attractive to international investors, and also investments that are valued much higher outside of Jamaica, because then it allows us the opportunity to build positions over time, because we have a longer time horizon. So that's why I said we're conservatively aggressive. So we're conservative in how we pick. But once we have made up our mind, we fling everything after it.
Right.
Because you don't get gems every day. And when you find a gem, you try and buy as much as you can until that exit comes. Because here's the big problem in investing. After you find a great investment, and you need to exit. After you exit, you end up back with cash.
What do you
And
do
you don't
back?
need to find another investment.
Right, exactly.
So you have to be very selective. And what we have found is that the best way to truly extract value out of all these investments is really to have a long-term time horizon. And Chris and I were having a chat the other day. In 2006, 10 million US was a lot of money
Right.
for us at Mayberry. And slow and steady is our mantra. And we woke up one day in 2019 and it's 150 million US, right? So systematically, so what we're saying is that to that individual investor, that's how you start, whether with $2,000, whether $10,000. But once you keep building on that, you're going to have a similar type scenario where you wake up one day and a $2,000 or $10,000 is now 100 million, a billion, or maybe 100 billion. We don't know. I'm not going to restrict anybody's view. I'm just saying slow and steady has worked very well for us, and we try to adapt as you move to a bigger and bigger number or a bigger and bigger level, because you know that now to double 10 million is easier than to double 150 million.
Yeah, yeah.
Yeah. So you now need to look differently on your investments. But with enough time and research and patience, we'll get there.
I have no doubt, and the results really do speak for themselves. I've really enjoyed the journey. I think in the last 5 years, I have actively participated in the investments with every opportunity that I've gotten, and I really have to agree with Mr. Berry. There's no greater way to create wealth than investing in the stock market, and I'm really proud of what Mayberry does in that regard, both through MJE
So
and through
Dan,
MIL itself. Yes, Mr.
one
Berry.
of our guests, one of our guests online is asking about what are we doing with our digital transformation. How is that going, Mr. CEO?
You know, that again is our secret sauce, and we are on track to fully digitize our business. And I think we have one of the best, if not the best, app out there in my ecosystem. That's based on the feedback that I've gotten from customers who are customers of Mayberry, and also customers of the competition. And it started very simply from being an app where you could just go in and determine what your statement is. We have kind of turbocharged it where you can actually do certain transactions, and we have a lot of transactions being done on the app. As with every digital implementation, there are challenges, there have been bugs, so we've had to apologize to some of those clients that that have the bugs and stuff. But I remind people, remember it was Windows 96, and by the time you buy Windows 96, there was 97, 98, 99. So it's part of the process. It's new, it's different, it's change. So we are working very quickly on it, and we have established a position where we're listening. So we want to have the best app out there, not just app, but we want to have the best digital infrastructure, so that we can interface and do significantly more businesses with our customers. And why that's exciting for us at Mayberry is that the digitization of the business is changing how the business is done. And so when I go out on the road, there are people that will come up to me and say, hey, I wish we had you as our advisor, and the whole 9 yards. But without a digital environment, it's difficult to reach all these people. But now that we're digitized, it allows us to create, for example, certain portfolios that wherever you are in Jamaica, you just need an RTGS, an ACH, and you can send it up, and it's going to be managed by, Chris, the team, etc. For the first time, you'll be able to get that type of exposure. So whether it's your individual retirement plan, which, as I said, is one of the best returns for the last couple of years, whether it's our asset management portfolio, we had one of the best yielding Jamaican dollar asset management product. We have managed products for individuals, and when the market was paying 2 or 3%, we had a portfolio that was paying 5 and 6%. Mm-hmm. But a lot of people didn't know.
Yeah.
And yeah, is that on me in terms of not getting it out there some more? We tried, but the distribution lines aren't what they should be. But that's what excites me now, because once we're now digital, it's significantly easier for us to get to people, and most importantly for people to get to us. So keep on the lookout. We're improving every day, and we expect that we'll hit our target date to be fully digital at the business. And I close by giving you an interesting point a lot of people don't know. One of the beautiful things we learned in COVID There was a time in the initial stage of COVID where there was talk about a national lockdown. And, when we went into a risk management mode, we said, listen, we have to contemplate an environment where people can't come physically to the office, right? This is long before work from home is gonna, right? And people can't physically come here. How do we deal with that? And we actually sent everybody home. Nobody was allowed to come to the office. No customer was allowed to come to the office. It was on a Friday. And we ran the business fully automated that day. And we balanced everything and the place didn't pop down. And that was a real eye opener. Not one single person was at 1.5 Oxford Road that Friday. And we ran the business without any material issue on that day. So we got a glimpse into the future as to what the future is going to be. And I can tell you, it's exciting. It might be scary to some, but it's exciting. It's exciting. And with us at Mayberry, you have a good partner to get and enjoy this future along with making a ton load of money.
Excellent. No, I appreciate that insight, Gary, and I have no doubt that going digital will make us more capable of serving our clients better and scaling up the business a lot more. So at Mayberry, I like to think of us as being little but tolerant, little in the sense that we're not trying to have 1,000 employees or 20 branches. We're doing it from one main location and a dedicated team of about 120 persons, but yet we have 40 billion on balance sheet, maybe 40 billion off balance sheet managing. And I think we've just touched the tip of the iceberg, as Chairman likes to say. Chairman, what you've been doing here for the last 37 years, I think, is exceptional. You jumped into the stock market when many persons didn't understand it, didn't believe in it. I believe Mayberry is one of the first companies to offer margin business to clientele to get them to appreciate the beauty of using leverage to buy equities when most persons are using leverage to buy cars and homes. And so you've always been on the cutting edge in terms of promoting investing in the Jamaica Stock Exchange, which has created wealth for many of our clients and made the company do very well. I mean, what do you see in the future? Are there any changes you would like to see in relation to the stock market, the GSC, the rules, or in general, any concerns, any thoughts you have about the direction that we're headed in as a country, regulatory or otherwise? What's exciting you? What's on your mind?
Well, on the regulatory front, I think, there are a lot of positive things happening. Where the FSC has been definitely upgrading some of the rules around raising money, and that's very important to protect the market going forward. Unfortunately, though, along with that, I've noticed that they seem to have difficulty with the higher volume of work that they're getting. So in the old days, what used to happen is that the only thing the FSC really had to deal with was equity transactions. The banks did all of the loans, and there was a very small bond market. But the bond market in Jamaica has exploded, especially since they changed that law about the transfer tax on loans, and the government needs to give them a bigger budget so they have more people, so that they can be able to evaluate and process these transactions a lot faster, because this holds up expansion of the industry. And at first, it was only securities dealers that were doing these bonds, but now even the banks are doing them. And customers see value in having loans as well as bonds. So, and I think as time passes, you're going to see a lot more types of securities that traditionally have been issued in Jamaica being issued, because the markets get more sophisticated and so forth and so on. So I think definitely we need to invest as a country more in our FSC, because that will allow us to grow faster, because you can't grow without financing, whether it be equity or debt. And usually it's always a combination. If you're a smart financial engineer, you want to have some debt in the company because that helps to improve your return on equity.
Awesome.
So I will say that that will be the main thing. I think from Mayberry's perspective, we have been investing a tremendous amount of money in the capacity of our financial advisors to advise. And we have grown our team of advisors quite substantially over the years. And we're not, as I tell them, we're not in the business of selling stocks and bonds. We're really in the business of advising people, because it's not whether you buy a stock or a bond, is which one you buy, when you buy it, when you sell it, and so forth and so on, and what mix of securities to have. So we're really a company that's selling advice, not stocks and bonds.
Thanks for that,
So we have
Chairman.
been investing a lot of money in our advisory team, on the investment banking side for sure, and definitely on the retail side. So those are the main two things I see, along with the digitization. The digitization is definitely going to be powerful for us, because we only have one branch, and what this does is this gives us tremendous capacity to expand while keeping our costs very stable. Our IT costs have gone through the roof, but in term relative to the capacity we have created, it's pretty cheap, much cheaper than buying buildings. So that's what I see for the future. Finally, I just want to make this statement because I said it in 2014, and I'm going to say it again. Jamaica is in the longest, biggest bull market you have ever seen, right? As long as the government keeps paying down the debt, right, and keeping fiscal responsibility, you're going to see more investments taking place. The economy is going to expand, and the market's going to keep growing. The main thing the government has to do now is invest in the human resources in the civil service. The civil service is very underinvested. And so it takes people to come up with the policies and to run the operational side of the government. The government is losing out because they're not investing in their people enough. They need to get some real good human resource people there to advise them. And if they put the right investments in the civil service, you will see Jamaica move to between 5 and 8% per annum GDP growth. That's where the bottleneck is right now. The government needs to invest in the human resources in the civil service. It's way, way underinvested. And that's when you will see some real rotted money.
Thanks for that,
That's the
Chairman.
big opportunity. That's the low hanging fruit. So that's what I want to see.
Thanks, Chairman. I really appreciate that insight. And then last question for me will be for Gary, and I think it's quite apt given the Chairman's comment is, we're seeing rising interest rates, Gary, and those are going to be with us for a little bit, I think. Are you concerned about them, and do you think that'll negatively impact, or how do you see that impacting upon Mayberry and your secret sauce and what you guys are doing? Should we be concerned about those rising interest rates and any possible negative impact on Mayberry?
I think it'll be slightly positive when I look on the overall portfolio of Mayberry. But the first thing I would say, when we talk about investment, we talk about cash flow. And this is one of the reasons you invest for cash flow.
Mm-hmm.
So the market is changing fundamentally from a very, very low interest rate environment. But if you have a business that throws off cash,
Mm-hmm.
The higher interest rate is not going to slow down potentially what that business is doing. So if you cycle through the different businesses in the MJ portfolio, for example, and I'll give you two quick ones. In the case of SVL, SVL has a cash pile which they pay out in dividends every year.
Yep.
In between the period that you have that cash pile, instead of now earning 1% on that cash, you're now going to be earning 4, 5, 6% on that cash. So that's going to start to drive their earnings. CPJ, again, is similar. The holding cost might be a little bit higher, but you have an ability to adjust your margins. And sometimes, in an environment where your costs are going up, you can adjust your margin higher than what it was before, right? So I don't see that being an issue for a lot of the companies in the portfolio. I think where the challenge is and what the big proviso is, subject is how far interest rates will go. I've always maintained that, I think the fact that BOJ started earlier than most central banks to start to raise interest rates, it allowed the market to become sensitized to the fact that interest rates were going up. Right. People forget back in the day, you could see a 5 or 10% movement in interest rates, not 5 or 10 basis points,
Yes.
5 or 10% movements. So that gradual increase started to send that signal. There are some people who were able to start adjusting their portfolios. So I think now that people recognize that, this is where we are, that impact is not as great because it allowed certain people to adjust. You're looking internationally, we made the point that the US is behind on increasing their interest rates. One bit of good news is that, they're indicating that the inflationary pressures seem to be slowing in the US. So even though they're increasing, they have more interest rates they're going to increase interest rates some more, at least one of the indicators indicate that the inflationary pressure is starting to abate. So what you want to raise interest rates to do, to pull it back, that's a good sign. Given what happens in the U.S., I think will determine how high and how long our interest rates or higher interest rates will be around. And the challenge is there's a belief that if the U.S. raises their interest rates too high, then we're going to go into a recession. And if you go into a recession, that's going to pull interest rates back down. So, when I look at it, I think you have a 2-year period where, I think interest rates will hover somewhere around this space for the rest of the year, maybe another 50 basis points max. Because you're seeing where the central bank is focused more on dealing with the dollar as opposed to, the continual movement of interest rates, because they do impact each other. So net, in terms of the Mayberry business, I think it's going to be slightly positive, because we'll have to adjust up our rates right across our lending capacity to make up to compensate for the spread. I think our foreign exchange business will benefit again, because you still would have the same level of volatility there. Our asset management business is a great time, because you're building that, so you get a lot of cash in, so we can do more. And in getting the cash on the asset management, it obviously assists your side of the business, which is investment banking, so you can do more corporate deals. And you'll be structuring more corporate deals that probably have more variability in them, because people aren't sure. So the days of having fixed rate deals for 5 years, 10 years, that might slow a bit. But certainly within the next 6 months, I think we'll have a better feel for what will happen with the interest rates. But given what it is, I think Mayberry will continue to do well, and in a way actually might do better in that rising interest rate environment.
Yeah, I'm inclined to agree, and just two points on that. I know Mayberry isn't big on doing consumer-based loans. Most of the loan portfolios we're supporting are commercial ventures. And then secondly, despite this rise in interest rates, we're not seeing that sort of have a negative impact on the stock market. It's not like the typical theory of higher interest rates might lower PEs and folks' appetite to invest in equities. We're not seeing that at all. In fact, the bull market, in my view, is continuing, and the appetite to invest in equities as an asset class, I don't think is being sort of distracted by the adjustment to interest rates. So, yeah, I also think it's going to have a positive impact on Mayberry.
Well, I mean, just to extend on your point, I don't think we've seen a broad-based reduction in PEs, but certainly on certain stocks, you're seeing their PEs coming under a little pressure. But again, coming back to the point that Chris made about the key points of invested in these businesses, once you have the cash flows, etc. So if you're invested in these types of companies, even if you see a slight contraction in the PE down the road, that underlying growth in the business is going to compensate for it in terms of profits. Yeah, and there's a point I made at an earlier time in that coming out of COVID, there are some companies that have done significantly well out of COVID.
Yeah.
Right, and it's some of the larger companies in the country. And now that we're out of COVID, they're going to do even better. You have seen the results from NCB. You've seen that they've started to come back. Yeah. So I don't necessarily see the major investors like the pension funds, etc., necessarily allowing an NCB to get to a 5 times PE or and to be fair, you have a sure and steady like Scotia. Their PE never got to levels then that was just outlandish.
Yeah.
I mean, even though it's still at 13.
Despite the fall off in their
Yeah.
earnings, yeah.
But like you, I'm optimistic. I think we will be able to settle at a level of interest rates that, and to close my point, I think what is going to happen, you're going to have a segmentation of companies on the exchange. So people are going to put companies into certain categories and say, okay, fine. I mean, outside of your normal blue chip, so there are going to be certain companies that, we think these companies will do well, whether bull or not, with the interest rates of this. And then you're going to have those companies coming down the line. And whatever that bottom bucket is, I think that's where you're going to start to see the PE contraction. And it will start to fall off as you get to the top of the bucket.
I appreciate that. Well, gents.
So another way to look at it, Dan, is like
Yes, Chairman, go ahead.
in any investment portfolio, there are companies that have an easy way to expand, right? So if you take SVL, for example, we have an expansion plan for SVL for the next 5 years. That's already mapped out. And it's not in one area. We have like 6 different areas we are growing right now. So if interest rates go up, it's not going to affect SVL because SVL has organic growth and M&A growth that is just going to keep propelling it forward regardless of the interest rate. You take a company like CPJ, for example, right? CPJ is in the tourism industry. I don't care what the interest rates are.
Go ahead,
Go ahead,
Chris.
No, go ahead.
So Dan is saying something.
No, not to you.
No, go ahead, Chris.
Go ahead. Continue, Chris.
Yeah, you take CPJ, for example. CPJ, I don't see tourism, even if you have a recession in the US, I think tourism in 2022 is going to be stronger than 2021. I think 2023 is going to be stronger than 2022. And 2024 is going to be stronger than 23. That's what I'm projecting. So there's a clear runway there. You take a company like Grace Kennedy, they're expanding in their food and they're in a huge market. Same thing with Jamaica Broilers. Their US operations are growing fantastic. They're expanding. I don't see interest rates affecting those companies' growth. And once the profits are growing, what you're more likely to see is like if you have an overall contraction in the market PE, then it may affect certain companies. Their PE may pull back a little, but if your earnings is strong, your earnings also is going to be pushing your price. So there's a trade-off there. So I think you have to look in your portfolio, look on the stock market, and look at the companies that have ways of growing and have the capital and they're producing cash flow to grow. And if you look on it that way, right now, I don't see it as a really big threat for us.
Thanks for that, Chairman. Couldn't agree with you more. Well, folks, we've just gone a little bit over the time, but I hope you appreciated why we had to do this update. Again, in summary, just to share the 2021 results for MIL and the $3 billion financial results, which I think has been spectacular. Well, we'd like to thank our viewers for tuning in today for our sudden...
You said that EPS was that?
What did I say the EPS was?
The earnings per share?
$1.72.
Oh, and what's the multiple?
5.85 when the market average is about 14 times. Great. Well, thanks for that. Well, folks, thanks for tuning in today. We really appreciate it. We'd like to thank our viewers for tuning in today for this sudden but significant live stream. Your support is always appreciated. I'd also like to thank my fellow panelists, Chris Berry and Gary Peart, for their contributions to today's investor briefing. Thank you, gentlemen. They'll be back to join me this Monday at 6 p.m. for another update, this time on Mayberry's first quarter results to March 31st, 2022. So please be sure to come back. Be sure to look out for our virtual investor update forum on Wednesday on our YouTube channel as usual as well. Don't forget to turn on your post notifications as we'll be providing more insights for other companies that are coming up next. Remember to subscribe to our YouTube channel, Mayberry Investments Limited, to catch all of the action. And thanks always for tuning in. Keep safe and remember, wise investors, Gary.
Slow and steady wins the race.
Bye-bye, guys.